Welcome to the final panel. We are very conscious that we're at the end of an excellent and full day of programming, and that this panel is the only thing standing between you and a rooftop cocktail. So we're going to be mindful of the clock, and we're going to run things efficiently. But I'd like to start by quickly providing a little additional color on our excellent panel, which I'm going to do in reverse alphabetical order. So I'm going to start with Karen Moriarty. So Karen Moriarty is the first woman search funder. Pretty cool. Pretty cool. Karen raised her search fund in 1992 and founded Carillon Assisted Living in North Carolina in 1996. Over the years, Karen has built 21 assisted living facilities across the state, and her 22-plus year IRR is 30%. 30%. And over the last 10 years or so, Karen has made the not uncommon transition from CEO to investor and board member. So she has versatility and range. Jason Pananos, with his partner Jay Davis, bought an aerial pest control business called Vector Disease Control in 2011. Jason managed to grow the business organically at decent rates, but he and Jay also created enormous value with a series of add-on acquisitions, and in fact, over the years, they did 13 tuck-in acquisitions. They sold the company earlier this year, generating a 44% IRR and a 9x multiple of capital. And since that closing, Jason has also made that transition, that happy transition, from CEO to investor board member. So he's also wearing two hats up here today. Coley Andrews is the co-founder and managing partner of Pacific Lake Partners, an investment firm founded exclusively to invest in search funds with $250 million in assets under management, an office in San Francisco, a very cool office in Boston. Coley and his firm are conference sponsors, and they have invested in over 150 searches and 55 operating companies over the last 9 years. So thank you guys for participating. We're going to start with the topic of boards, which I know Jose's panel touched on this morning, but sort of mathematically, as you think about search funds going forward and as deals continue to close, one of the biggest challenges facing the community is the long-term supply of quality board members, quality directors. And of course, as Jose's panel touched on this morning, search fund boards are very different than typical private equity boards. And so we're going to start by asking you, Coley, maybe to start if you don't mind. So what generally are the qualities of an effective search fund director? How do you think about that?
Yeah, so I think there's a really important distinction to appreciate between what's a good deal and what's a good deal for a first-time CEO. And that obviously translates right into how to be an effective director when you're dealing with a first-time entrepreneur, a first-time CEO, who's got all the hustle and heart and smarts of everyone in this room and a big component of what draws us into this ecosystem, but who has not actually been in the seat as a manager. Most of us have been doers our whole life, but that's very different than growing into someone who can lead and manage and delegate. The most effective search fund directors, which is something that I've spent a lot of time on with Jason and many of his colleagues over the last 2 years interviewing and talking to them about, is someone who has an appreciation for what that sort of day one to day 365 experience and more is like. And that appreciation then leads to patience, understanding, forgiveness, but also a recognition that tactical, specific advice and a willingness to get deep into what's going on in the CEO's world is really important for building that relationship for the young CEO to feel a sense of trust, to reach out when problems arise. Because a lot of the problems are not first-time problems. They've all been gone through this movie before in some way, shape, or form. And to the extent that you, as an early CEO, can have someone who's an operating director with that background to lean on, that can make a huge difference in avoiding material mistakes up front and accelerating the curve from a time perspective where then you can really start building your business. So the feedback that we get is those who are available, engaged, and willing to really work through the problem at hand to understand how that part of your situation, your snowflake, is affecting your day-to-day, are the ones that can have a major impact on the CEOs and therefore on the outcome as well.
Great, thanks. Thinking about this supply question, sort of long-term supply of talent, what do you guys think are potential sources for high-quality directors? Like where do we as a community look to find people who fit Coley's description?
Well, I certainly think my cohort of CEOs that have sold businesses and are now available as investors and board members, I think that's a helpful source to potentially solve the supply issue. But I think at the same time, being a successful CEO is much different than being a successful board member. So I think it is still important, both from the investor side, to be able to spread out experienced search fund directors in combination with my cohort who's exited businesses and has capacity to sit on boards. But I still need board experience to be as effective as a search fund director who's been doing this for 10, 20 years. So it's kind of an investor problem to help spread some of that knowledge, both in the US and internationally, but also on the entrepreneur side, as you think about forming your investor groups and influencing who becomes your board, to think about that as well and have some of that balance of very experienced board members, obviously some industry expertise, but potentially people like me that haven't been in your shoes. It hasn't been too long since I've been in your shoes.
Yeah, the only thing I would add is those that have operating experience, even if it's slightly different than the size of a search fund business, maybe it's a tier above in size and scale, can be a very effective place to start. That does not mean, though, going to someone who's run a $1 billion plus company for the last 10 years. That's just a very different experience than what these folks are getting into. So to the extent that there are people in your network that are of that background, talk to them and introduce them to the folks that have been around the hoop for a while. And I think pretty quickly you can tell the ones that are interested in getting engaged and know that they've been successful, but appreciate that the reasons for success going forward for somebody else might be different than their own success.
Well, and what I'll add to that is over 22 years of having a board, I have very sort of strong thoughts on board size and composition. To be very granular, I think a 5-person board is phenomenal. Below that, you don't get enough interaction, and you find that the conversation can be oftentimes diminished at the actual board meeting. And so as a CEO, you're not getting as much out of that meeting if you have a board that's too small. Bigger than that, just ridiculously unmanageable. That's just my point of view. If you have 5, I think you need 3 operators. And so, there's a tension there because you have, if you're fortunate, and that is the way I think about it, you have funds backing you or, large net worth individuals who are essentially a proxy for funds. And so they often want the lead board seat. So you've got the financial source, the financial partner, PE, you've got the CEO, and then there are 3 left. And I personally think it's very important as you're vetting funds as potential investors that you have that conversation up front. Because the person who's going to be most helpful, and one of my board members is sitting on this stage, the person who's going to be most helpful is the guy who sat in that chair. They sat in that chair maybe 2 years ago, if you're fortunate, 5 years ago. But it's really important that you have that level of granular input. So when we advise, or when I advise searchers who've now found their deal and they're putting their equity together, you can go out and use that equity opportunity to attract really interesting talent. The folks who've just recently exited, who maybe weren't in on your search deal, but now there's an opportunity that you've created. So I think you have to work a little harder. It's worth it. Coley will tell you, there are people who work at Carillon who are now board candidates for Pacific Lake. Will and I sit on a board together with my VP of development, phenomenally talented people. It doesn't always, depending upon the size of the company, it doesn't necessarily need to be the CEO. It could be the COO. If it's a real estate or development business, it could be somebody in that vein as well.
So just following up on that, so Jason, you were talking about the value of sort of the recent successful search fund operator. I think there's no question about that. And Coley, you sort of, and Karen, you picked up on it, you mentioned the value of people with more general operating experience potentially in larger companies. Okay, so my question is, where do you draw that line? And specifically, sort of, what are the backgrounds that are potentially not a fit for a search fund board versus a more traditional private equity board? How do you guys think about that?
I think the easiest line to draw is starting scale, and that's usually a function, or the easiest proxy for that is revenue or number of employees, right? Because there's a different type of experience managing a business with 10 million of revenue and 20 to 50 million employees than there is with 200 million of revenue or 2 billion and 500 plus employees. So having an appreciation for having been at that level, even if they're not at that level today, but having been there somewhere in the recent past, I think is a super easy place to draw the line, because they can relate very much to what your day-to-day experience will be like.
Yeah, and so so that makes complete sense. How about the experience with large company operating talent in search funds? There's often a temptation to seek industry experience from the largest player in a given industry. That's the best known, often most prestigious firm. Do you guys have a point of view on that?
We didn't have we couldn't find a mosquito person to join our board. I've obviously seen where industry experience can be really valuable, as talked about today. My personal opinion is that sort of the experience with a first-time CEO and size of business kind of trumps industry experience, all else equal, just because, again, these smaller businesses are just so different than larger businesses, and first-time CEO is so different. But ideally, you can get both.
Yeah.
But that's, again, I didn't have that experience, so that's probably about all I could say.
Yeah, I mean, for what it's worth, that's been my experience. Very consistent with what you guys have said. The very large companies are often not a fit. It's just such an entirely different operating environment. So I think that's sort of a question mark. Okay, so shifting focus a little bit, a number of North American search fund investors have commented recently that international search funders occasionally find deals that don't fit the model. So I'm curious, maybe starting again with you, Coley, on this, has that been your experience? And then
Yeah.
just quickly, and if it has been, sort of what's the high-level framework you use in evaluating sort of search fund businesses?
Yeah, sure. So I'd say the answer to that question is yes, that's been a general experience in the last few years. And it's not surprising, right? Because those of you that are not in the US are operating and searching in markets where the pool of companies available is a fraction of what it is in the US. And I just referenced the US because that's obviously where the longest set of data and experience is that we can draw upon. So it's not surprising that you might find things that don't necessarily fit some of these core criteria that have been around for a while, which I'll hit now and talk about how to think about this. So, it was probably 10 or so years ago where, give the credit to Will, where he and his firm went through all of the known outcomes in the search fund world and separated those into the winners, the losers, and the ones in between. And they weren't really that focused on the ones in the middle. They were focused on the outliers to success and failure to see if there were distinguishing characteristics between the two. And there were. The successful ones were, as you all have probably heard many, many times, the B2B recurring revenue service businesses that were generally asset light and simple businesses to manage with a history of profits and growth. And probably, maybe most importantly, in industries that were growing at roughly twice the rate of GDP or more, which is meaningful. And it sort of highlights the importance of having that secular tailwind behind you. The pool of companies that had not been successful were a random mix of businesses that included retail, heavy manufacturing, distribution, businesses tied to global cyclicality where things out of your control can put you in trouble pretty quickly. And what we have seen, which if you've looked at the most recent Stanford study that came out a couple days ago, that actually returns have been improving in our world over the last 10 years, which is a pretty powerful statement of support. And I believe that one of the big reasons for that is a narrowing of focus in the US around the types of businesses that are more likely to be successful and bought through this model. So I think the challenge on the international front is when you have a more limited supply of companies to look at, how far off the fairway are you willing to stray for your own decision to maximize your own probability of success? And I think that's a conversation that's important to have between you and your investors, and to be honest with yourself around, how much additional risk am I taking on here by expanding the range of the business model or the industry characteristics that I'm willing to entertain for my acquisition.
Great. So we intentionally sort of started there because with boards and sort of industry selection, because those are two variables over which search funders have control that have an enormous impact on probability of success. So that's sort of the principle we're starting with. And we're now going to discuss two variations on kind of the core acquisition model, search fund acquisition model, both of which have increasing relevance for funds outside of North America. And we're going to start by turning to Karen to talk about greenfields. And when I use the term greenfields, I mean startups originating out of search funds. And greenfields are much more prevalent among international searches than they are among North American searches. So according to the most recent IASE study, they account for about 10% of total searches versus 2% in North America. And the returns overall to greenfields have been exceptional. And Karen, to my left here, is sort of the world's leading expert on greenfields because she's been running one for 20 plus years. And she's also the lead director at a very successful second one in the US called Convenient MD in the urgent care area. So Karen, let's start with, how did you end up with a greenfield? You were the first.
I was. I ended up starting Carillon because I'd been through several years of a search, frustratingly so. Found this industry, senior care in general, and found that back in '96 there was an offshoot of the industry called assisted living, which was slightly lesser acuity, younger in age, but you couldn't acquire anything at a price you were willing to pay. So if you think about it, that is not too dissimilar from today. There's a lot out there you'd like to acquire, but are you willing to pay the price for it? So I put together a business plan that required a staged call of capital over a number of years, went out and hired people who had done it before so that effectively I was the weak link in the investment thesis. So we had solid managers, I researched states and where we needed to be and relocated to North Carolina from California, hired the first two individuals, and consequently, because also of the fact that we were able to put leverage in place, it's a real estate-based business, so we're able to do project-level financing, we were able to basically utilize today what is thus far only $6 million in equity in driving the growth of the company. So I love greenfield. I love to work with entrepreneurs, searchers who maybe have a little bit of a hybrid model, and by that I mean what you find today might be really tiny. So Coley has an experience, there's a searcher who's about to close on a concierge medicine deal, and he found the industry, loved it, could not afford to buy anything, rationally could not afford to buy anything. And so what he's done is he actually pre-funded with a fairly significant amount of equity, and he went out and searched for the company, and the company is a very small physician practice in San Francisco, and he's going to use that as a base for future acquisitions. But if you looked at it as a standalone opportunity, it couldn't support the CEO salary, it couldn't support the infrastructure, so he treated it as greenfield. So I think there's a phenomenal benefit to doing greenfield. You can take somebody else's playbook in a different space. So for example, if you're in Latin America, a lot of the spaces that you've seen where people have done investments in the US, you can take that concept and tropicalize that model and do a greenfield there. Or you can do that, I'm going to acquire something very small, but the business plan looks much more like a greenfield. And it's fun and engaging for all of us to advise the searcher CEO, because we've already made all those mistakes. Our goal is that we help you make new and different ones and avoid ours, candidly.
So Karen, what are the, more generally, what are the characteristics that you look for in a greenfield that you're going to invest in and get involved with, or that you think define an industry that's potentially attractive for a greenfield approach?
I look for success elsewhere. So in other words, has somebody else done it? Convenient MD, urgent care, it existed, they just couldn't buy it at an attractive price. I like to see all the basic structural elements. In other words, does it have that recurring revenue? Is it business to business? Is it generally got a good tailwind? But has it just not been done here? I like to see, and this is harder, just the sound fundamentals of the post-start operating plan. So a lot of times I'll get on the phone with people. It's less about what you put on paper, but we will start a conversation. Show me your org chart. What are your thoughts on what's it going to take to run this company? And then we'll, at a very granular level, can they articulate a way to create kind of that black box, the operating black box? Can you find your way very sequentially with our assistants to grow this from nothing to something else? And it involves sort of a very sequential, disciplined approach to how am I getting from A to B to C to D. The entrepreneur's willingness and ability to do that paired with a space that's got good growth, someone else has been successful, and you're just sort of stealing their model is really what I like to see.
So when you structure a greenfield and you're staging in the capital, so can you talk about that? How do you design that to sort of time the different stages to mitigation of
Right.
risks as you go along?
Well, and I know, Cola, you've been instrumental in negotiating the concierge medicine, but I'll just talk about what we did and what I've seen at Convenient MD. We overcalled, and I'll put that in quotes, we overcalled equity. So we just said, I can't find a way right now to use this today, but I'm going to raise this significantly larger than needed amount, and I'm going to put a business plan together that says I'm going to build X boxes a year in our case, and therefore, I will have revenue and then cash flow, and so basically on paper, stage the timing of the capital calls to the size of the business, and then go out and try and deliver on those deadlines. So we called the money that we thought we would at, generally speaking, the time that we thought we would. But I am a big fan of over-equitizing. Yeah, you are going to pay a little bit of, you will pay in terms of the price, IRR price today. It's nothing like the dilution you pay for a second or third round if you're not quite at the trajectory or on the trajectory you want to be on.
Great. Cole, you got anything to add on that?
The only thing I'd add is, at Alpha Credit, there was a very similar approach, right? And it's a slightly different business, but the idea was to over-equitize to be able to fund the initial loan book of business, and they were able to collect a significant amount of data on that performance within a 9 to 12-month period, and pre-established milestones had been set that, subject to those milestones being hit within a reasonable window of time, the remaining capital would automatically be released, assuming board approval, which is what happened. So it was a very structured way to walk before you run, and I think that's, never say never, but I do think that's probably the only way to go about these type of opportunities, because it's a way you can really prove the concept rationally and thoughtfully and with limited capital risk before you then dial it up. And by the way, once things start to go well, people want to dial it up, and it starts to get really fun.
That's great. So the world's other leading expert on greenfields moderated this morning's first panel, Jose Stella, so there'll be ample opportunity at drinks if you're curious about greenfields to talk to either Karen or Jose. So let's move. I mentioned there were sort of two variations on the model, greenfields being one. The other one is consolidations, and we'll turn to you, Jason. So the history of search funds with consolidations has been mixed overall, truly mixed, some good outcomes and some less good outcomes. But you guys had great success with the consolidation at VDCI. So what allowed you guys to be successful sort of serially acquiring and integrating pest control businesses and aquatics?
Yeah, so I think the key things with a consolidation, and I think roll up has been kind of a dirty word for a few decades. Consolidation, I feel like, just represents more thoughtful, patient, as opposed to roll up, which kind of has a negative connotation with it. But so I think for me, I think the key is, the initial acquisition has to work on its own. It could be small. For example, we didn't go into our deal. We thought there might be a consolidation opportunity, but it wasn't the rationale for the deal. And I think having the initial acquisition make sense on its own is big. I think if you're overpaying for the initial acquisition and you have to, try to de-lever purchase price by doing follow-on deals gets a little tricky. Being patient is certainly another attribute. So, we as first-time CEOs, as many of us are, in our situation, it was 2 years before we did our first tuck-in acquisition. And it was 4.5 or 5 years before we really stepped on the gas pedal in terms of how many deals per year we were doing. So we were able to get through a few integrations one at a time, make a lot of mistakes, learn from those, have our team, as much as it was helpful for me and my partner to learn, our team also learned as well. So, I think a very non-linear approach to ramping up an acquisition program is really important. And obviously, prudent capital allocation. So luckily we were in a space where we could buy highly recurring revenue at a very attractive price. So having price discipline is obviously very important as well. So I think if you can, put those things together and have a very long-term focused view, I think, consolidations can be an interesting strategy. In sort of relation to the international side of things, I guess I'll say a couple things real quickly, but it was mentioned a little bit this morning, but when you think about looking at some of the consolidation plays in the US or mature markets, the benefit for potential for international consolidations is that you can look at some of the stories that have played out successfully in those markets, but are probably don't have enough runway to be an opportunity today. But in many of the international markets, there's opportunity to steal those ideas and play that out. So I think that's a exciting opportunity in outside the U.S. And then I guess secondly, what I would say in terms of supply of companies, if you really look at a long-term focus, I'm talking decade, 15, 20-year focus, and you can have that mindset. What's interesting, you have to have highly recurring revenue. All else equal, you want organic growth. But what's interesting about looking at a consolidation model, you need some organic lift, but the sensitivity to a consolidation model, organic growth is actually not as sensitive as you might think, as opposed to the purchase price and long-term capital allocation. So getting back to thinking about the supply of companies in some of these international situations, you may be able to expand the possibilities of industries if you can find highly recurring businesses that have sort of a long-term consolidation play in mind.
So just zeroing in on pacing. So just walking through the first 5 years, what was the pacing? You did the Basis Fee DCI deal, 2011. When was what did the next few years look like? When did you do the first tuck-in?
Yeah, so the first deal, first tuck-in was 2 years after our initial acquisition. We did one deal a year after that. And then that next year we did 2 deals. So that put us at, that was about 5. And then that got us to about the 4.5-year mark. And then we did 5 deals that next year. And I guess one thing to note on that, as we brought in those initial first couple deals, we certainly integrated things that we had to, things like financial reporting, getting bank accounts controls, insurance, a lot of the administrative side of things. But we were very patient integrating operations and businesses, and we were essentially buying branches and geographies. So we were able to do that, but we really couldn't step on the gas pedal until we had really put everything into a platform. And we didn't really do that until the 5th acquisition. But I think, in hindsight, I think that benefited us, because if we had tried to do a lot of integration early on, we just didn't have the experience, and we probably would have made some mistakes. The flip side of that is it was harder to put that platform together when we had 4 pieces to put together. But I do think, again, being first-time CEOs, that certainly helped us learn our integration program before we really stepped on the gas pedal.
And so, leverage. You mentioned capital allocation as sort of being critical to driving long-term returns. So when did you guys how did you evolve your approach to leverage over time?
Yeah, so we started with about 2 times EBITDA leverage in the business. And, we weren't fast growing, but we had pretty attractive cash dynamics. So we did pay down some of that debt in the early couple of years. So, the first acquisition we were able to do through debt, and we were still pretty underlevered. And as we ramped up, about 3.5 years in, we brought in mezzanine lending as well. But even our combined senior and mezz, we typically manage that to around 3.5 to 4 times EBITDA at the highest. But again, by that point, we had been in the business 3.5 years. We were very comfortable with our stability and our ability to predict 12, 24 months out. But we never really went over 4 times. And since we were buying these recurring revenue streams at very attractive prices, 3 to 4 times max, in some ways we could actually de-lever through acquisition because we were levered at 4 and we were buying companies at 3. And because we had very good lending partners, we were actually able to dividend out our cash that we were accumulating throughout that process. So, and again, what made that possible, that was obviously a great situation to be in, but what made that possible is we had highly recurring revenue. We were very disciplined about what we were paying for businesses, and we were thoughtful about how we allocated capital.
Yeah, great. I mean, you guys did a phenomenal job optimizing the balance sheet. So last question. So if you were going to advise one of the CEOs here who was thinking about making their first add-on acquisition, and there were sort of 2 mistakes you'd want to help them avoid, what would those be?
Yeah, so I would say, don't do it too soon. So I think being at least a year in before you close a deal, in my opinion, is prudent. And, depending on whether it's a geographic add-on or something in your geography, I personally would, integrate what you have to, but, be patient about, rationalizing staff or doing major integration decisions immediately after that first tuck-in, because similar to buying your initial business, you might form opinions about people or processes that turn out to be different after that first year. So I think again, if you can be patient in that integration process, assuming the business can operate without that, I think that's prudent as well. And don't try to do 2 at the same time either. I think you start with 1. See how that goes, and then you can go from there.
Great. Okay, so we're going to shift focus a little bit. So one of the most significant trends in the last 5 to 10 years has been the rise in funds like Pacific Lake, Coley's firm, Anacapa, and others dedicated to investing in search funds. And so I guess and that trend seems likely to continue going forward. So and sort of thinking about the broader landscape looking forward. So first of all, is that a good thing? And I'm going to start with Karen and Jason. They'll give Coley credit at that.
Sometimes think about that.
So is that a good thing? And then the second question would be sort of looking forward 5 years, what might that landscape look like, both for the funds and for other investors and for searchers?
My perspective is that it is a good thing. I think anyone has to be balanced when they contemplate their investor group. But as you're going out there as a brand new CEO with limited to no experience, your job is job 1 is certainty of close. You need to put the proper amount of equity into play. And what you find is that working with a fund, first of all, broadens your network. So you automatically have more individuals who will invest alongside, and really gives you depth of expertise after the fact. So again, what you're looking for is what are the knockout blows post-closing that are just going to crater the company. There has to be balance. I think the beauty of it is if you have a good deal and you have an institutional investor, a PE fund behind you, you get a lot of people interested and you can scale everybody back. And that's I know you guys don't like to hear it, that includes the fund. And that's a great position to be in as a CEO, to be able to scale people back a little bit. Sorry, Coley. But that ability to have the professional networks, to have their expertise, you don't want to be the guy running around trying to close, in my opinion. If you've got a $5 million raise, you don't want to have to fill $2 million from your friends and, colleagues. Start with the big money. They will attract participants. And, you will, if you're working with the right fund of people who've done this before and understand that this investing is not venture investing and it's not even PE investing, it's well worth the price, both stated and implicit.
Jason?
Yeah, so I'll talk about hold periods for a minute. And, I don't know what goes through other people's minds, but certainly my initial thought process as there became funds and, institutions in the search fund world was, they're going to have time funds. They might force me to sell. And I actually think the opposite is true with funds out there for a few reasons. But, I think the LPs that tend to be in these funds tend to be, search fund CEOs or people that have been involved with the model for a long time and understand the power of long-term holds. I think the principals of these funds are kind of thought leaders about how to foster longer-term holds. And full disclosure, Pacific Lake was my largest investor, and my experience and what I'm seeing is there's absolutely no pressure from funds to push entrepreneurs to sell. I think it's very much entrepreneur-driven, and I think because of the capacity that funds have, it's going to again, talking about what we're going to see in 5 years, I think we'll see hold periods get longer because there'll be more thoughtful discussions with entrepreneurs about how to achieve that and make that work for the investors. So I think that's actually a positive development that funds will bring to our network, and it's the opposite of what you might think on the surface.
Yeah, and for what it's worth, I strongly agree with what Karen and Jason's point of view on that. I'm not going to ask Coley that question. But Coley, I would be interested, so where do you sort of see this headed down the road, right? So look 5 years out, what do you think that landscape looks like, both for the institutional funds like yourselves and for the other players?
Yeah. Well, there's been a really big shift even in the last 10 years. And so the question is it going to persist, accelerate, or slow down? And the shift has been, with the volume of entrepreneurs for the previous 20 years, there could be a small network of 20 to 30 high net worth individual investors who could support that activity and support it in a way that it needs supporting. What do I mean by that? It's the engagement, it's the experience, it's the willing to lean in a meaningful way to support and mentor the next generation of entrepreneurs. Obviously, you guys have all seen the stats, and as the numbers have quadrupled over the last 4 or 5 years, that initial core group of individuals cannot support that, right? And that is where I do think there will be continued sort of evolution going forward around the people who are allocating more time. Because at the end of the day, that's the scarcest resource we all have, right? So to the extent that there are individuals who are available, willing, and capable, they will, I believe, remain very active and present in an important part of the ecosystem. We want them. Entrepreneurs want them. It's critical for long-term success. But I also think that groups like ours and many others who are willing to dedicate that time will continue to be an active and important role, because that's what the ecosystem will demand, that level of engagement. The question will be, what does that mix shift look like over time? And I don't think it's going to be that dramatic, but I do think entrepreneurs have choice now, and that's a really great thing that's healthy for all of us. And over time, they'll make the choices to where the people are that will help them maximize their odds of success.
Great. And I want to go back to something, Jason, you mentioned. So I'm changing topics here. So you mentioned sort of the phenomenon around year 4 or year 5 in a successful, so this is something that's gotten a lot of attention among the North American search fund community over the last 24 months. So there's a recurring opportunity for potential misalignment between searcher CEOs and their investor group around year 4 or year 5 in a successful search fund transaction. And so at that juncture, the searcher very naturally may have an incentive to seek a transaction of some sort, a sale or a recap that crystallizes their performance equity. And the investor group may have a decided preference to continue to own and hold and grow the business. You know, the best search fund outcomes riddled throughout the Stanford study are generally, you know, longer than 5 years, many of them longer than 10 years. Karen's a bit extreme in that regard, but there are some 20-year holds as well. So question to you guys is, how should boards think about that situation? So, and I think a whole cohort of the international search fund transactions are sort of approaching that point in time. So you're at year 4 or year 5, you're in a successful search transaction. How should the board and investor group think about that? Anyone want to take that?
Yeah, I'll jump in that. I think it's super important. We have seen businesses accelerate to sale for this dynamic that otherwise don't need to be sold. And that is lost opportunity for us as investors, and I don't know if it's lost opportunity for the CEOs because they generate liquidity and can potentially keep going. But for the investors, absolutely, that's an unfortunate outcome. And by the way, still a very good individual outcome, but relative to what it could be, it's a major issue. So we very much support the board having the authority to engage in that conversation with the CEOs when the CEOs want to talk about it. And that's a controversial thing for me to say as an investor. I think there are investors in here that probably will cringe to hear me say that. But I think it's really important. And it gets down to trust of who's at the table. And we've got to all trust each other, and to a certain degree, if this model is going to continue to grow and persist. And trust centers around, hey, like, does the opportunity warrant a conversation to vest, reward, compensate the CEOs for a lot of success? And the answer is, generally, I think when the success is clearly there, the answer is, yeah, it is. When it's on the margin, it might be, well, maybe, we got to see how this plays out a little bit. Because, you know, particularly in the last 10 years, we've all been in a bull run, and that could change, right? But not having an environment where you can have that conversation is an unfortunate and unnecessary failure. So I think it's very important.
So Karen and Jason, you guys wear dual hats on this topic. How do you think about it?
I mean, I'm very passionate about this, so I believe, you know, there's a dialogue that needs to happen. So I don't have a whole lot to add to what Coley said. But, you know, to the extent as a community we can increase hold periods, it's a win for entrepreneurs and investors. And there's definitely, every situation is going to be a little bit different. But I think if we can have that dialogue, it's going to be very impactful in the next 5 to 10 years on what outcomes will look like.
And I think it should be highly relationship-based. What I mean by that is, you don't want to be in a situation where you're sitting at a board meeting, the market for your industry is ridiculously hot, and your board says, you know, I think we should contemplate a process. And you know, then every decision thereafter is you thinking about, where am I on my performance vest? You know, if you start, you know, 24 months well before the kind of whatever the date is for your performance vesting, to talk about, hey, the market is fantastic, or whatever the rationale is, we should think about taking this to market, but I'm not sure. I would just like to know that if and when we get there, that we can talk about the performance vesting. And you're not asking for a guarantee, a commitment. We've had, like, on the investor side, so now I have my investor hat on, we've had people where sometimes at the board level you feel like if you don't do something, you've got the CEO literally kind of dragging their feet to the transaction finish line because their vesting might not look like what they want it to look like. So it's almost kind of that opposite situation where I'd love to sell if we were vested, you know, where I think it's important to have the conversation really early. And I suspect, as I've seen it played out a number of times, if it is in the interest of the investors, they will make sure that it is in the interests of the CEO. I mean, at Caroline, we had a situation back at the 2000 timeframe where I don't think we could give the company away. We could have given it away for like non-cash consideration, right? The market had been trashed U.S. There were a lot of bankruptcies, very public failures. And the board said we should sell. We decided not to sell because we magically went from not profitable to cash flowing in the process. It's amazing what that will do for you, by the way. But the board then came back to us and said, hey, we want to do this. And we said, we'd love to do it. Right now, our equity is underwater. How about we talk about fixing that? And I and several of my partners in the company have done extremely well. But part of that was, and it's not always popular, it was being a good soldier. It was like, okay, I don't really want to sell the company, and I can see visibility to profitability, but I'm going to do the right thing and trust these people that I've known for a long time that they will do the right things, and they did.
Great. Okay, so shifting topics a little bit, I think one of the structural challenges with international search funds is that you have a dispersed investor group geographically. So you've got typically you've got local investors and you've got a cohort from North America. And so that makes, that creates challenges around investor engagement. How can searchers most productively engage their investor group, which theoretically should be one of their greatest assets, to help them both during the search phase and post-acquisition in the deal phase, in the CEO running the company phase. So you guys have thoughts on that, sort of best practices for either searchers in that situation now or CEOs running companies?
I think it starts with expectation setting, right? So as you're thinking about it as a searcher, right, why are you going to have a mix of both people? And I recommend that it's a good idea. They're going to play different roles, and so talk about that up front, right? I don't think I can be very effective helping you navigate the cultural nuances of engaging with a Spanish or a German seller. That sounds really fun, but I'm not going to be the right person for that. There are other people that are local investors who are going to be much more effective there, right? But there are transferable skills from how you run your search and how you evaluate the businesses and how you be an effective CEO in the first 18 to 24 months that I think go global and cross the world, right? So pick and choose your spots and your people and set expectations around that. And also, I would say, find ways to get those folks to interact in some way, shape, or form, right? There are a lot of new faces here compared to the last 2 conferences, and that's exciting, right? But there's also a lot of new faces. And I think it's important for people to get to know each other, particularly those that are going to be in this for a long period of time, so that you can get to that trust-building component and say, hey, I can appreciate how so-and-so is really helping on this dimension, and he or she appreciates that this other person's helping on that dimension. And that's a little bit on you as the entrepreneur and the CEO. If you want to maximize the output you get from your investor team and your board, which you heard earlier, own that and drive that. And I can assure you that I think people will respond really effectively to that.
Great. Okay, so we're going to touch quickly on a few sort of miscellaneous topics that fall under this challenges to the search fund going forward topic, and then we'll open it up for Q&A. So I want to circle back on attracting directors, sort of new high-quality director talent into the community. And I want to touch quickly on the topic of board compensation. So basically, the model for compensating search fund directors is effectively unchanged in the 25 years I've been involved in the community. I mean, to the actual amount of board fee paid hasn't moved in 25 years. And I think it's a valid question if we're going to be opening up the aperture here and talking to other potential candidates, what's the right way to compensate this minority group within a much larger investor group who raised their hands to do the heavy lifting of being on a search fund board? And to do that job well, it is heavy lifting, as everybody here who's been on one can attest. So I'm just curious, panelists, do you guys have thoughts on board compensation, and specifically what alternative models might make sense going forward, as we look to attract new talent into the mix?
Yeah, I mean, I think it's controversial to say, but my opinion is board members should have equity. What I see happening now that I don't like is using board roles to sort of allocate dollars in the follow-on equity for a deal. So maybe that's okay. I personally don't love that. I think if there is either, sometimes you can't have significant cash compensation, but I'd certainly be a net payer of equity if that becomes more common. But I certainly think it's my opinion is that would be one way to have more engaged board members, increase the pool, get kind of solve this potential problem. So.
And I think on that topic, once you have the actual deal in hand and you have to raise the equity, you should be immediately focused on that board composition. So I think if you're out, especially international, and you're looking for someone who can be a mentor, advisor type of board member, to create an equity opportunity for that person who was not even aware of the search fund concept, perhaps, I like that, because I do think you want them invested mentally and also with their balance sheet. And I think that they may not have been present. So I think one of the currencies that I've seen effectively used is a creation of a disproportionate allocation, or just making room for the guy who wasn't in your search deal. And I think that can be very effective. I think on compensation, it's funny, on cash compensation, I see especially small-sized deals where the searcher's trying to not pay anything in the early years. And the bizarre thing about that is, so first of all, we're all time constrained. And we have to figure out, are we willing to get on a plane? Are we willing to travel that far? What are you willing to live with in terms of, of pain? And to hear, knowing that our biggest investment in you is probably going to be in those first couple of years, to hear you talk as a CEO about, well, I don't want to pay board fees for the first couple of years because ... It's like, life's too short. So for us, we have a finite amount of resources. Those are time, the time being the primary one. But I know that that's often the most difficult time in a CEO's mind for how do I use my capital. That's how I think about it.
Yeah, you have three tools, right? Allocation of equity, cash compensation, and upside performance-based equity. I think, especially given your point on the time in the first 24 months, the biggest way you're going to shift that attention is allocation of equity. So I feel a little differently than Jason about that, right? Most people who are doing this, they're doing it to the ability to invest and be a part of it and have the return on their capital be meaningful enough to them. Cash, I think, is important from the standpoint of I'm paying you and I'm expecting you to show up, okay? This is not, you're out of business school once we get out of here, right? This is kind of the real world, and it matters. And there is dollar amounts that I do think should go up, and Will, I think, has a perspective on that's formed by 25 years, but it's just the principle too. And the last piece I would say is the equity piece, I think, is absolutely a reasonable conversation. Personally, I believe that there needs to be a proportion there where skin in the game materially is higher than the equity on the upside that you're going to gain. And the reason for that is this is not venture capital. Okay, if you look at the Stanford study on distribution of acquisitions, 70% of them make money. Our experience is significantly higher than that. And I think that's what you want. You want high probability of success as an entrepreneur. And so the minute you start shifting directors into optionality to the upside and no downside, I think you're putting your own situation at higher risk. So I think that's a super important balance to maintain.
Yep.
And
Go ahead,
just from
Karen.
the international perspective, so I think there are a lot of us here who are very interested in international investing, and for us that means international board work. So I think the job is to find a way to make that easy for us. I personally think that the traveling, so if you're in Brazil, one's in Brazil and one's in the US, the traveling board member should get like 2x. So if you're the Brazilian traveling to the US, but it's hard to get on that plane, and I'm not talking about the easy 6-hour flight. It is hard to get on the plane. It's, it turns into 2-3 days. You need to think about easing pain points for your board members, because your job is to attract, again, you want operators. They are time constrained. You must make it both easy, attractive, and interesting for them. And as an international searcher, a good strategy for thinking about, okay, how do I do this in a country perhaps that has no history in search investing? Well, you get a good half. You're looking for that mentor domestically in your country. You're looking for that mentor investor. But then you're going to go back and tap the US, and you're going to pull in the funds, and you're going to pull in the people who've done it before, and it's perfectly fine to fill out half your deal, if not more, with US investors, because that will pull in the last part of your domestic investor group. But in order to keep those people engaged, you're going to have to find a way for it not to be painful.
Yeah, I mean, I would just circle that topic and say that is a subject that is ripe for innovation. And I would hope if we're sitting here 5 years from now, we have a different model in place and it's no longer on the list of subjects. Okay, so I'm going to pause. I'm going to stop there. We're just about at the hour mark and open it up for Q&A. And if we end up having to go up to the rooftop early, I think that's not a bad outcome.
good with
So,
that.
questions?
I've got a question for Jason. You said in your conversations specifically about platform roll-ups that you are very disciplined around price. And we're in a deal right now where it is a platform roll-up, relatively small base company with the idea of purchasing several different companies along the way. And I'm having a conversation with the CEO because he's reporting the acquisition multiple as based on the post-synergy calculation of EBITDA. And I'm really interested in what we're paying based on the EBITDA that the seller is actually generating. Do you have a point of view on that? And as you think about price discipline, how much do you take into account the synergies that you actually bring to the deal in calculating the price you're going to pay?
Yeah, good question. And it's consolidation, Blake, not so in our business, I mean, we were, again, fortunate enough that there wasn't competition, so we were able to kind of price on nominal EBITDA. There wasn't a ton of synergy anyway, so there was some benefit that we didn't necessarily account for in our models. I think when you're in a potential business where consolidation does have significant synergies if you're rolling in branches or you have fixed cost. Ideally, you keep as much of the synergy as possible. I think it totally depends on the business where you may have, if you're competing against other buyers, if you can give away some of that maybe. But I mean, I think ideally you don't have to. You keep as much of the synergy as possible.
Great. Question right there.
Question is for Jason. You mentioned the word platform, which is a word that gets used a lot in consolidation strategies. Can you just flesh that out a little bit more? Like, what does that mean exactly?
Yeah, so it's a good question. I mean, I think ideally, again, if you're going to do a consolidation, you have a platform that is sizable, it's not just a branch or a small business. You do have some infrastructure there. I think if it's smaller, again, I think in the right circumstance, you can start with something smaller, but it's still, that deal still has to work on its own. So even if it's a small business and may not have high absolute dollars, that it could still work on its own with a return. But again, I think that the smaller you get with that platform, it gets harder and more dangerous. So I would suggest, as we think about platform, it's similar to how you would think of, what's the typical size of any acquisition you would want to do, and ideally that's where you start.
And just building off of what Jason said, I think that term platform has been used historically in this consolidation area to justify large valuations for the base deal. In other words, the only way the IRR made sense on the platform investment was if there were a lot of accretive tuck-ins, which is entirely different than what the approach, Jason, you described at VDCI and going forward, where the IRR, if your thinking is the IRR in that base deal has to be good, then it's not a platform in that broader sense in terms of needing to do acquisitions to work. Totally different approach. Question?
Coley, you mentioned or highlighted earlier that we've been in a pretty good economic cycle for the last 9-10 years, and given in the prior presentation, we saw a lot of warning signs for what might happen on a go-forward basis. As you look to deploy capital, how do you think about cycles?
Yeah. It's impossible to not think about it, especially where we are right now. And so the way that we think about it is just looking for, maximum durability. So it's sort of my earlier point on the expansion of the variety of businesses that are, I think, being considered generally, but in particular internationally, I believe that's where you're introducing the more of the uncontrollable risk as we enter into this, potentially different period over the next 3, 4, 5 years. But we also have been thinking that for the last 3 or 4 years. So, who knows? But I think the proof is in the pudding that even some great businesses that were bought in 2005, 6, and 7 in the U.S. Grew right through 07, 8, 9, 10, and turned out to be phenomenal outcomes on the back end. So it does, for me, start with the core criteria and the industry opportunity and the talent of the entrepreneur. And then to the extent you want to layer on other uncontrollable variables, I think you do so just with eyes wide open, particularly where we are in the cycle.
Mario?
So I see a lot of the conversation being around the board composition and how board members are being sourced and how they're joining the entrepreneurs. But I don't see a lot of the conversation being focused on how the entrepreneur is actually evaluating their board and if they're happy or not. And I think that's the other part of the equation. And I would like to know your thoughts about mechanisms that would allow entrepreneurs to have the boards that they want after they've chosen initially, because there's also a lot of unhappy entrepreneurs, and I think there's not a mechanism to
Yep.
shape things around.
So did everyone hear that question? So let me just repeat it. So Mario's basically asking if there are mechanisms that might allow for CEOs to provide feedback systematically to their boards. That our perspective in this conversation has been mostly centered on the board members, but what's,
And change the board composition.
and if that feedback is poor, to affect change, to have put a better board in place. So what do you guys think?
I'm a big fan of, right from the outset, thinking about terms, and talking to your boards about, like, this is I'd like to do a 2-year term, and we'll mutually evaluate, because you will find people who say, I only want to make a 2-year commitment to you. There's no reason why it can't be both ways. And that way, you can see, usually, there are issues around attendance, kind of how much value added, and I think they're mutually recognized. Usually you have a board member saying to you, I'm really not doing a very good job for you. So I think if you formalize the opportunity, and then you actually have to remember to use it. If you never pull it out and dust it off, then people forget.
You guys have anything else on that? Peter, you had a question?
So talking about aligning interests at 4 or 5 years out, part of it is, you mentioned and we talked about, was vesting of performance shares. The other part of it is liquidity. Sometimes entrepreneurs have started a family, or they just want to de-risk a little bit. How do you think about what is the right amount to allow, between $0, I'm going to put it in euros, how it's €0 and unlimited euros in terms of as a board member or as a shareholder supporting in terms of liquidity?
You guys have any thoughts on that?
Yeah, my answer to that is it's relative, but it should be sourced or driven by the CEO, right? So I can think of situations that we've been in where, when the CEO comes and had to have that conversation, which is totally reasonable and appropriate, and in fact, I often would like and prefer that they have some liquidity to take some pressure off and be focused on really building something over a 10-year period. It's a magnitude of how much relative to what the current value is worth, right? And I think there's major signaling effect in that, by the way, when it's, hey, I want to sell 60 or 70% of my stake, right, versus I want to sell 15% of my stake or 10% or what have you. But generally, I think it's usually a low 7-figure amount, which is enough to, take the edge off a little bit, a hard 7-8 year entrepreneurial career when you do have a young family and have been making reasonable money, but the bank account is not full. That tends to be where I think things can get solved in a way that is what the entrepreneurs are looking for.
Well, and I think a related topic that we've seen come up a lot is what happens when you ultimately are selling to the PE fund. So you've hit all your targets, you're 100% performance vested, and then the high bidder, numbers 1, 2, and 3 are PE firms or entities backed by funds. And the answer is that we sort of see a plus or minus about a 25% rollover of entrepreneur equity being asked and given. I mean, they'll ask for a lot more, and you'll pitch the opposite answer, but the settling in sort of that 25% number seems to be a market number. And that's hard to think about because all you've heard is you've entered the transaction, you've heard valuation, liquidity, I'm free at last. And it's a different outcome.
Yeah, so I want to just circle, so Peter's question relates to a different situation where you're into a deal and you want, the entrepreneurs expressed interest in liquidity, the deal is going well, and the board is trying to solve that problem. And in my experience, that problem has always gotten solved, and it's in the investor's interest to solve it. It will make the CEO more energized, driven, risk-seeking. It takes it's a very positive thing generally for all parties. What Karen's describing is a specific situation that's related but different, but it's very common, particularly in an environment like this, where there are a lot of exits in the search fund community, a lot of them to larger PE firms. And so the question is, what if a searcher is being required to roll, say 25%, into the new deal, and by definition the new deal is occurring at a super high valuation, the result of a great auction in a very frothy market, what's the right way for a board to think about that and be fair to the CEO? You guys have any thoughts?
My experience has been, if you're actually going to sell, that's usually driven by the buyer. So there's only so much influence. I do think that's an important conversation to have early rather than later, because the leverage shifts out of your favor later. So get that clear up front. Hey, this is what I'm doing. This is the only thing I'm doing. And in this environment, you can ask for that, which is great. So usually I don't find misalignment at all between the CEO and the current board, but it's a question of who else is at the table.
And Clay, when you say that, you mean having that conversation early with the PE firm?
Yeah.
Yeah, so I think that, I agree. I think that's the key principle, right? If you're in an auction, this is one of the asks that needs to be front and center in your markup and everything about the deal to all the buyers, not a term that gets negotiated after a headline value is in place. So I think that is best practices. And then it's probably case dependent.
Thank you.
Simon.
We're seeing phenomenal growth in the number of search funds over recent years. Do you think potentially due to success it's attracting maybe some wrong type of searchers? And related to that, is there a wrong type of capital that's potentially being attracted as well?
Well, I'll answer that. I don't know about wrong types, but the growth I do not think has been parallel. Let's just put it that way. And there's a difference between, I think, looking at this as a career step / a job versus, an entrepreneurial bet on myself. And that's where I see the lines getting grayed a little bit on the entrepreneur side. So that's sort of maybe one answer to your question. And then on the investor side, I do think there is a wrong type of capital for sure. And it gets to some of the points that were made earlier around timing and pressure. People that are coming in expecting fast liquidity, fast activity, I think will end up in a fast train wreck. This is a go slow to go fast approach, and that doesn't generally suit, I think, most people out there. I mean, I bet it suits most of the people in this room, but we see it's a very clear dividing line in conversations we have with capital providers that most of them, that's actually not what they're looking for. And I don't think from a direct perspective into this ecosystem, that's healthy for all of us.
Yes, Raj.
Just building a little bit on Simon's question there, and more about as this concept is international, different markets have very different multiples and very different characteristics. And I'm talking specifically about the UK. A lot of searchers in the UK have found it difficult to convince US investors about some of the multiples that are paid in the market. And actually, the scale at which PE operates in the UK, I mean, to find $1 million recurring revenue EBIT business in the UK that's not being heavily bid for by major PE is quite difficult. And so maybe some of the concepts need to change for each market. That's kind of one. And the second thing is everywhere, as you're expanding the envelope now, you're starting to look at the concept of greenfield and interesting ideas. The other end of the spectrum is obviously distress. And is there any
Distress.
appetite for that? Yeah.
Okay. So I missed the last part of your question. What was it?
It's just, is there any appetite for that? So when
For,
people are
for,
looking-
for in other words, for investing in distressed companies, turnaround sorts of things.
Yeah.
Okay, so we're going to do a quick lightning round on this one. Coley.
No on distressed. So,
Okay.
not
Yeah,
for us.
Jason.
I would say no because of, first-time CEOs. I think
Right.
that would be very
Yeah.
challenging.
Karen.
I agree.
I do as well. I think it's a good question, but I do as well. Okay, so I think we have time for one
Well,
more.
Will, there was a part A there, though, that was, I think is worth addressing really quickly.
I mean, relevant multiples,
Relevant-
yeah,
yeah.
sorry.
Right, so, I'm going to steal your phrase on this, but I and we believe that margin of safety in the search fund world is the quality of the business that you buy, not the price that you pay. So I don't know what to say about a specific situation in the UK, but I will tell you, we're not afraid to pay what is not a 4 to 5x multiple for an attractive, solid B2B recurring revenue service businesses in a growing fragmented industry. Because our experience has been relative to what that business will sell at above 5 million of EBITDA, there's an enormous valuation gap. Obviously today in a frothy market, but even outside of that in a correction. So valuation, I believe, is more relative, specifically maybe to country, but definitely industry, growth, and company, than some sort of fixed range that's sort of a right multiple for the search fund model. That's my point of view.
Yeah. And I think if you put together again, if you're focused on the much smaller size, so it's not even a platform yet. It's just a going concern that lets you as the searcher learn via that experience and acquire some base level of operations and ideally some base level of management expertise that you can get in that way, because there may be fewer deals of the larger size where the bidding is frothy, but then put that pool of capital together and really look at a growth through organic and acquisition opportunity. But you're going to do it without a base. You're basically, it's a quasi greenfield. And I think there's great appetite for that among investors, U.S. and otherwise.
Yeah. And that all circles back to that earlier topic around industry criteria and the critical sort of foundational importance of that. So I think it's impossible to hit that too many times. But I think that's a wrap. So before Rob gave me an important reminder here. So this is the conclusion of another excellent day. I want to just freelance, and has this already been done? I want to thank Rob Johnson for all of the incredible work that goes into coordinating this. There's a broader committee involved, but really, it's Rob. It's pretty extraordinary. This is only the third one of these, and 370 attendees, so that's great. So Rob wanted me to give everyone the dates for the next one. So there's no excuse. Get that in your calendar, please. September 10th and 11th, 2019. Right? Here. Oh, sorry. Wait a minute. This is, okay, so we're on this cycle where we're alternating between IESA and Stanford. So that is the GSB. Peter's very involved with that, along with many others. So September 10th to 11th next year in Palo Alto.
Yes. Yep.
Okay?
First announcement of it.
Okay, great. Have it in your calendars. Thanks to the panelists, and see you on the roof.